This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and finish the start of our journey through strategic business reporting by pulling together everything that we've gone through and looked at within the previous set of videos on this updated conceptual framework. Remember what we said right at the very start in the very first video is that SBR is all about the application of the framework to a particular standard. As it is, it's at the moment thinking around current issues, but as the syllabus progresses, it will then just form part of any other question that is not related to current issues, because the framework can always be applied to any accounting standard. So what we've gone through and done within this example here at the end is to go through there and start to get you to think about how you would apply those principles, those fundamental ideas that are set there within the IASB Conceptual framework. Okay, and we've chosen 4 standards that you have seen previously, whether that was in F7 or whether that was in financial reporting. Hotel, motel, it doesn't matter, does it? Whether it was F7 or financial reporting, it's effectively exactly the same exam, isn't it? So what we've got there is we've chosen inventories, PPE, provisions, contingent assets and contingent liabilities, and intangibles. Yes, by all means, you may know the accounting standard number, but you don't need to know that accounting standard number within your strategic business reporting exam. You're not going to get yourself a bonus mark by talking about inventories and referring to IAS 2, because the likelihood is in the exam you'll be under pressure, and what you'll do is you'll say inventories IAS 7. You're looking at me going, it's obviously IAS 2. I know it is. I know you know that, but in the exam it does funny things to your head, doesn't it? So don't bother putting in the standard number. Just say inventories as per the standard. You don't need to worry about the number. Okay, but we'll talk about that more as the videos progress. So you've got those 4 accounting standards that you've got there. So effectively what I would generally think about is if I was looking at the framework, I'd think about 4 particular elements. Okay, so what I'd look at first of all is I think about the qualitative characteristics. So with a particular emphasis there more on the fundamental ones as opposed to the enhancing ones. But there's always an opportunity to throw in an enhancing qualitative characteristic as well. I then go through that and think about my definitions, the definitions of your assets, the definitions of your liability. I'd also then go through that and think about recognition and derecognition. So remember, we recognize an item, an asset, a liability if it gives us more relevant and faithful information. So going back, if you like, to the qualitative characteristics. And then remember that you derecognize an asset or derecognize a liability. The asset is when you have a loss of control. So when your PP is being disposed of and sold, you derecognize it because you no longer control it. Similar with IAS 2 and your inventories. You derecognize a provision when you have settled it, so therefore there is no obligation. Okay, so some easy marks in there in terms of the recognition, derecognition, and then what you've got as well is you're thinking about your measurements. Okay, so you've got those 4 specific areas to go through there and think about with regards to your measurements. Okay. And then when you're going through and looking at each of the standards, so let's just go through there and take your inventory. Okay, if you think about your inventory, what are the fundamental rules for valuing your inventory? I'll give you a few seconds to think about it. Hopefully you can remember. It's one of the first things that you saw when you were there in the days of F3 or financial accounting. Remember, your inventory there is at the lower of your cost versus your net realizable value, isn't it? Okay. So if you're thinking back to what we have here in terms of the framework, okay. Well, if you're thinking about your definitions, well, inventory itself meets the definition of an asset, doesn't it? It arises from a past event when it was purchased. You control that inventory because you determine how you go through there and use it. And then it is a present economic resource, isn't it? Because it's there within your business, so you are then able to sell it and generate a profit, aren't we? Okay. So that meets the definition of an asset. You could also go through that and think about recognizing the inventory. So you recognize the inventory because it gives us more relevant and faithful information, doesn't it? So relevant, it's important to go through there, isn't it? If we go through, where are we in terms of our definitions? There we go. It makes a difference, the decisions made by users, doesn't it? If you didn't include it, how would the owners know the stewardship of the business with regards to that asset? Okay. And it also has there some faithful information as well, because that then ties it in, doesn't it, to prudence, because we're effectively looking there at the lower of your cost and NRV, so that there is looking at the reintroduction, if you like, of prudence into the framework. And then when you're thinking about your cost versus NRV, we're looking there, aren't we, at your measurements. So the cost effectively is your historic cost, isn't it? And the NRV is going through there, isn't it? And looking at your current value. Your current value here being fair value, isn't it? Okay. Excellent. That's how we begin to go through and do it. Okay. If we go through there and then have a look at PPE. Again, I'm not going to write it down as IAS 16, but if you think about PPE, again, we can go through that and think about it with regards to your initial measurements, your subsequent measurement, and then, if you like, your derecognition. So initially, you recognize it at cost. So that is part of your measurement basis, isn't it? Subsequent is there, isn't it? At your historic cost, part of your measurement. So that will involve some depreciation. So that, if you like, is giving us more relevant information, isn't it, in terms of the consumption of the economic benefit with regards to this asset. Or subsequently, it could also be that using the revaluation model. So again, when you're using the revaluation model, again, you're thinking about your measurements. Again, measurement here tends to be there, is it at fair value? But also here, you could also have it based upon your current cost if it is a specialized asset. And if it's a specialized asset, when you're revaluing it, you can use your depreciated replacement cost. Okay. Again, when you're thinking about your initial not only have you got your measurement, but you've also got your recognition criteria. So you are recognizing it, because by doing so, it gives more relevant and useful and faithful information to the users of the accounts. You could also go through as well, if you think about PPE. PPE is by definition an asset, isn't it? Because it's arisen from a past event. We control that item, property, plant and equipment. We look and determine how we use it. And again, it is a present economic resource, isn't it? Okay. And then when we go through that and derecognize, so that's looking at the derecognition criteria. So effectively, we're looking there when it is sold, there will be, if you like, a loss of control. Okay. Excellent. You can throw in all sorts of bits and pieces as well in terms of your comparability. I think we mentioned that in one of the earlier videos. So we ensure there when we revalue, don't we? The class of assets. So we don't revalue an individual asset, we revalue all of the assets within that class. We can also think about timeliness. Again, thinking about your evaluation. You know, the fair value, the best estimate of fair value is when we sell the asset. Well, we can't wait until we sell it. So therefore we use fair value, and we have a standard that helps us with the fair value of our assets. Similarly, as well, we're thinking as well about understandability and giving information to the user of the accounts about our depreciation policy. You know, how do we go through and depreciate it? Is it straight line? Is it reducing balance? What period is it depreciated over? What is the percentage used in terms of our reducing balance? And as well, thinking about property, plant and equipment, you could also bring in a little bit of presentation and disclosure with regards to your other comprehensive income, and the revaluation is recognized in OCI, and then that is then not transferred through to profit or loss on the subsequent disposal of that PPE. It's just a reserve transfer. But I think I'm just going a little bit too far for this early in the syllabus. Okay, you tend to hopefully get the idea. If we then go through there, think about provisions. I think you start to then pick up the picture in terms of your provisions. So again, we can think about the qualitative characteristics. So when you're thinking about your qualitative characteristics, again, we're thinking back to faithful information or faithful representation, because again, we're bringing in an element there, isn't it, of prudence, and also measurement uncertainty. Because if we can't measure that provision, then we record it as a contingent liability, don't we? We do not record it there as a provision. Okay, so bringing in that new element relating to your measurement uncertainty and enhancing a little bit there about your prudence. So thinking there about how we then measure it with regards to the best estimate of the provision. Okay, and starting to think there about your expected values. If you have a large sample with regards to your provision, thinking about warranty provisions. Again, you see a familiar picture. We're thinking there, aren't we, about the definition. So when we're looking at the definition, we're thinking about the definition of a liability. So the key bit there, isn't it, is that we do have that present obligation. The standard goes through there and gives you the additional detail, doesn't it, about that present obligation, whether regards it there being a legal obligation or a constructive obligation. Okay. and then you've got it arising from a past event, and there is a transfer of economic resource. That transfer of economic resource being that future cash payment or that future potential transfer of an asset. You've also got as well, haven't you? Can I fit it all in? Possibly not. But you've got there as well your recognition and your derecognition. So you recognise the provision when it gives more relevant and faithful information. So that's therefore when you can measure it with more certainty. So once there is a certainty about the measurement, then you can recognise that provision. And then the derecognition of the provision is when there is no obligation. So when that provision has been settled and when there has been a payment. Okay. And then within there as well, you can start thinking about, if you're thinking about your relevance with regards to the recognition, you recognise the provision when it's material. The measurement, you discount it back to present value when that difference between the settlement value and the present value is material. So again, giving more relevant information, but you then need to bring in a little bit about the measurement, don't we? Okay, the measurement effectively is thinking about it being at your current value. So thinking about your fair value, isn't it? Okay, and you can start thinking there about the different levels and assuming then it'd be like a level 3 valuation and discounting things back to present value. Okay. You've then got as well, what was the fourth one? Was that intangibles? So if I go through and start thinking about your intangibles, and then the best way to think about intangibles is to go through there, keep it as simple as possible. Think about your research. Think about your development. Okay, so the key bit about your research is that there is no asset. Why? Because it doesn't go through there and meet the definition of an asset. Okay, we have no control potentially of that research. We're unsure about the measurement uncertainty in relation to that research, and there's no measurement uncertainty, then we cannot go through there and recognize that asset. Okay. If you think about the definition of a present economic resource, is there a present economic resource that we have? We're not sure yet because we're just carrying out experiments for the sake then of trying to find something that we can then develop, aren't we? Okay, so there's no asset. However, when you get to the development stage, you do recognize an asset. So you're looking at the definition and you're also thinking as well, aren't we, about the recognition, because you then recognize that asset because it gives more relevant and faithful information. It goes through there. You are able to measure the fair value of that development expenditure. You know that you are going to generate an economic resource. It will bring in some benefits to the business. So therefore it can be recognized as it meets that definition of the assets. Okay, giving us more faithful and relevant information. You could also go through as well and think a little bit, if you like, then with regards to the assets. And the measurement of that asset. So we're starting to think there about your historic cost. So we capitalize it at cost and then we amortize it, don't we? We then go through there, think about the revaluation. Can we revalue your intangibles? You can, can't you? But it's very rare that we can do, okay? Because the intangibles need to be identical. And it's very rare that we have identical intangibles, isn't it? So the revaluation there brings about, if you like, a little bit of comparability, doesn't it? To ensure there that when we're revaluing an asset, we only revalue it if it meets the strict criteria. Because otherwise people will be revaluing some intangibles, some people wouldn't. So again, it brings you back, if you like, to the enhancing qualitative characteristics. Okay, if you like, going back to the enhancing qualitative characteristics and the research, again, it's not prudent to recognize that asset, is it, if we don't think it's going to generate any economic benefits. Okay. Intangibles, is there anything else that you could think about off the top of my head? You see a lot more, if you like, in Intangibles on IAS 38 when we talk it through in that particular chapter. I suppose the other one that you can think about as well is your internally generated. We don't recognize internally generated intangibles. Why? Because it doesn't meet the recognition criteria, giving more relevant and faithful information. I think, well, surely it does. Well, remember, in terms of your faithful information, your faithful representation of those transactions, we need measurement certainty, don't we? There's too much measurement uncertainty measuring that intangible. How can you separate out that brand from, if you like, the rest of the value of the business? So the important thing to take from this chapter, from these examples, is that it's important that you know the basic rules of the standards. And then once you know the basic rules of the standards, you can then go back and begin to apply it to the separate elements of the framework and think about the key elements of the framework that we've detailed there. So your qualitative characteristics in terms of the fundamental and the enhancing, the definitions of your assets and liabilities. I suppose you could include as well, if you like, equity within there too. Looking at your recognition and derecognition criteria. So recognition is all about the initial. Derecognition is all about what happens at the end when you dispose of the asset or pay off that liability. And then when you're thinking about your measurement, remember that's looking at your historic cost, which is the traditional way of accounting, but you've now got more up-to-date, relevant, useful information through your current value, thinking about fair value and linking it in, if you like, to IFRS 13, your value in use, your fulfillment value, and then your current cost as well. Okay, remember, think about your current value as entry and exit value as discussed in that earlier video. But other than that, that's it from me for now on the framework. Like I've said a few times as we've gone through the videos, keep this knowledge in your mind, and at the end of a chapter, start thinking about how you can then apply it to the rules on the framework. If memory serves me right, I think the examiner was quite sneaky recently and started to get you to think about IAS 21 and foreign currency and applying the framework there with regards specifically to the measurement bases. That's something to think about later on, isn't it? But enjoy the rest of the course, and I'll see you all for the next chapter. Bye for now.